Hi guys, today I'm the most sanctioned country in the world again. Let me know if you may be interested in this. But our later writer today, Daniel Gladiš of the Vltava Fund, starts with a sentence that flips the usual story on its head. He says, I invest in stocks because I'm trying to reduce certain risks in my life. Wait, reduce risk? Isn't the stock market a place where the people shout, panic, and occasionally lose their shirts or pants? Well, Gladiš has been steering the Vltava Fund for 21 years through 7 United States presidents, 8 British prime ministers, and 11 Japanese premiers, and the fund has multiplied its investors' money many times over. So maybe he knows a thing or two. His point is simple: cash. Bonds feel safe today, but across a lifetime, say 80 years, it quietly melts. The United States dollar, as you know, has lost more than 90% of its purchasing power in one human lifetime. Think of it as a slow leak in your life raft while you nap. Stocks, on the other hand, are like bigger, stronger boats. The S&P 500 index stood at 14.87 points in 1944. Today it is above 6,000. And back reinvested dividends, and the total return balloons to more than 5,000 times the original stake. So the first takeaway is not rocket science. If you do nothing, inflation is the shark circling your raft. If you step onto a sturdy vessel, high-quality companies held for years, you reduce the risk of drowning in rising prices. Now, Vltava Fund is not a lifeboat for everyone. It is open only to qualified investors, which is regulation speak for people who already have a nice pile of treasury. These passengers are not trying to turn $10 into a Lamborghini next month. They are trying to keep the Lamborghini they already own from rusting away. Gladiš reminds them gently but firmly that even the choice to stay in cash is still an investment decision, just a very poor one after inflation. In other words, if you have substantial wealth, you are already on the ocean. The only question is whether you choose a cruise ship or a rubber dinghy. Let's zoom out to the big map on the wall. Politics, headlines, elections, there are squalls that come and go. Gladiš counts them, for sure. 7 United States presidents in 21 years, 8 United Kingdom prime ministers, as in 9 Czech leaders, and so on, again and again, they're changing. Yet none of those names appear in his list of reasons to buy or sell a stock. The quote I love here is, I cannot recall a single case where we decided to buy or sell an investment based upon who was or was not the president. Instead, the fund hunts for what he calls ships built to sail even through storms. These are companies with durable competitive advantages, smart captains, by which I mean capable management, strong free cash flow, and sensible allocation of every extra dollar. When they hit rough seas, they don't sink, they adapt, get stronger, and sail on. That is why Vltava Fund's horizon is measured not in days, but in years. In fact, Gladiš jokes that he thinks in periods longer than 1,090 days, 3 full years rather than the 90-day quarters Wall Street obsesses over. Patience, he argues, is the last true edge an investor can have, because most of the crowd is day trading its life away, and precious time also. Picture an elegant ballroom filled with mirrors, champagne, and whispers. 6 ladies in silk gowns stands on stage, and every guest must vote for the one they think the other guests will choose as the prettiest. That, says Gladiš, is how short-term trading works. Economist John Maynard Keynes called it the beauty contest, and it is a game of guessing what everyone else is guessing. Not just guessing. Vltava Fund refuses to dance in that ballroom. Instead, they practice pricing, not timing. They estimate what a company is truly worth today. wait until the market offers that company at a big discount, and then buy calmly. Sorry, weather. They do not need to know what next week's headlines will be. They only need to know the difference between price and value, as Warren Buffett said. Here's a concrete example from 2024. Williams-Sonoma, the fancy kitchen goods retailer, was trading above 200 in January. I owned it also, but it's another story. The fund's estimate of its intrinsic value was much lower, so they sold. By spring, United Rentals, think of it as the world's largest closet for construction cranes, fell below $600. That price looked silly compared to the cash the business generates, so they happily bought more. No crystal ball, just arithmetic and patience. Speaking of spring, the fund did not add any brand new companies last quarter, but they were busy bargain hunting. They used the April dip to buy extra shares in 10 of their existing already holdings, half the portfolio. The biggest shopping cart additions went to Applied Materials, Lam Research, United Rentals, and Aero Electronics. They also topped up the position in the Nikkei 225 index, Japan's broad market. Gladiš confesses he could hardly believe some of the prices, and in the fund world, when your analyst says, "I can't believe my eyes," that is usually a bullish sign. Volatility, in their view, is not a storm to fear. It is the tide that washes interesting shells onto the beach. You just need to take it. Let's drop some numbers on the screen. A typical stock normally wiggles up or down about 40% from its early starting price, even if the underlying business barely changes. The company's real value shifts far more slowly. This gap between price and value is where wisdomed Vltava Fund fishes. They keep a shopping list of roughly 100 companies they understand deeply. Most of the time, those companies are priced too high, so the fund waits. When volatility spikes, price detach from reality, and the fund calmly checks off items on the list. Gladiš even writes, "We welcome volatility, a sentence you rarely hear outside of pirate movies." His dream weather report: higher volatility, higher uncertainty, and lower prices. That is music to their ears. Now, the letter does not contain colorful pie charts, but it does slip in one sobering statistic that deserves its own spotlight. The Federal Reserve Bank of Minneapolis calculates that cumulative United States inflation over the past 80 years has exceeded 1,500%. If you had buried $10 in your backyard in 1944, you would now need more than $150 to buy the same goods, guys. Meanwhile, the same $10 invested in the S&P 500 would have grown to more than $50,000 before dividends. That single comparison is the entire sermon. Cash silently shrinks. Equity in great companies silently multiplies. No fancy graphics needed at all. Let's dock the ship and summarize the cargo we've collected. First, investing is not about gambling. It is about choosing the right boat so that inflation's shark can't bite you. Second, politics and headlines are weather, not climate. Focus on the quality of the ship, not the clouds overhead. Third, the best edge you have is patience. The market's short-term beauty contest is crowded and noisy. The long-term harbor is wide open. As you see, nobody. Fourth, volatility is not your enemy. It is the tide that brings bargains. Keep a shopping list and a cool head. And finally, remember Gladiš's closing wish: higher volatility, higher uncertainty, and lower prices. When other investors reach for the life preservers, experienced sailors reach for their wallets. If you enjoyed this voyage, drop an anchor on the like button, subscribe for more plain English finance tips from best of investors, and share the video with a friend who still thinks cash under the mattress is safe. Until next time, keep your compass set on the long horizon, and may your portfolio sail steadily through every storm, fair winds.